Hey, everybody, you can put more money in an IRA in 2024 than you did last year. We're going to talk all about it. Before we do, please take a minute and click subscribe to my channel if you don't already. And take a minute, check out the link you see on your screen. You can get the top 10 stocks to buy right now from the Motley Fool. They're my sponsor, and it's the best way to support this work that I'm doing on YouTube. So, as I mentioned, for 2024, the IRA contribution limits are going up and by a significant amount. So for 2024, you can contribute up to $7,000 to your IRA. That's up from $6,500 in 2023. So a $500 contribution bump. There is a $1,000 additional catch up contribution allowed for those 50 and older. That's the same as in previous years. That hasn't been indexed for inflation, but will be going forward. So, short version, if you are 50 or older or will turn 50 in 2024, you can contribute up to $8,000 to your IRA in 2024. And as always, it's important to point out that this limit is per person, not per account. In other words, you can't open a traditional IRA and a Roth IRA and contribute $7,000 to both of them. You have to have your total contributions to all of your IRAs under that limit. This only applies to traditional and Roth IRAs. If you have one of the specialized types of IRAs that are common among business owners, such as a SEP IRA or a simple IRA, these limits don't apply to you. So let's go into what this means for traditional and Roth IRAs. So traditional IRAs, so anybody who earns income can contribute to a traditional IRA. Um, the question is, can you take a tax deduction for your contributions, which is generally one of the biggest perks of contributing to a traditional IRA. So while you can contribute, you can make non-deductible contributions if you don't qualify for the tax break, but you want the tax break. So here's what you need to know about income limits. So if you don't have a retirement plan at work, if your employer doesn't offer a retirement plan, or you're self-employed, there are no income limits. You can contribute to a traditional IRA up to the annual maximum and take a deduction. If you or your spouse do have a retirement plan at work, your ability to take the deduction is limited by your income. So it depends on your tax filing status. So how to read this chart on your screen right now is that first column where it says income limit for full deduction. If your income, which is your modified adjusted gross income, MAGI, is below that amount, you can take the full deduction even if you have a retirement plan at work. If your income is between the two columns, so for single, if it's between $77,000 and $87,000, that's called the phase out range. You can take some of the deduction, but not all of it. If your income exceeds the higher amount, so the $87,000 for single individuals, you can't use a traditional IRA deduction if you also have a retirement plan at work. So for single, the lower limit is $77,000 and the phase out limit is $87,000. If you are married filing jointly and have a retirement plan at work, your income must be below $123,000 to take a full traditional IRA deduction, but you could take a partial deduction with income up to $143,000. Now, if you don't have a retirement plan at work, but your spouse does, your income is still, your ability to take the deduction is still income based, but it's much higher limit than if you had your own retirement plan at work. So in these cases, the income limit to take the full deduction is $230,000, and that phases out completely over $240,000. And notice in the bottom line that married filing separately, you cannot take a full deduction no matter what your income is. You can take a partial deduction if your income is $10,000 or less, which is a very low limit. So the general rule is if you want to take a traditional IRA deduction or contribute to a Roth IRA, which we'll get to in a minute, you should not use the married filing separately status. That only makes sense in very few cases, which will be a topic for another video. For a Roth IRA, which just to kind of quickly refresh your memory, Roth IRAs, you don't get a deduction, but your eventual income in retirement will be tax free. Any withdrawals that qualify from a Roth IRA are tax free. So, unlike with a traditional IRA, Roth IRA contributions are income restricted for everyone. Roth IRAs were designed to help low to moderate income households save for retirement in a tax advantaged way. So, in order to make a full contribution to a Roth IRA, Your income needs to fall below the IRS threshold. Just like with traditional IRAs, there is a phase out range, which we'll see on the next slide. If you don't qualify to contribute to a Roth IRA, there is something called a backdoor method. You can Google that, but it generally involves putting money in a traditional IRA and immediately converting the account to a Roth IRA. There's an income limit to contribute directly to a Roth. There is no income limit to convert an account to a Roth. So that's one workaround if you really want a Roth IRA, but you don't qualify. So here are the income limits. There is a phase out range, as I mentioned. So if you're single, your modified adjusted gross income needs to be below $144,000 in 2024 to make a full Roth IRA contribution. To make a partial contribution, your income can be within that range of 144 to 153,000. And if your income exceeds 153,000, you cannot contribute to a Roth at all. For married couples filing jointly, the income limit for a full contribution is 214,000, and it phases out entirely above 228,000. And as with the traditional IRA, married filing separately is a status that generally cannot contribute to a Roth IRA. And if you can, it's because you have a very, very, very low income. Um, so just to kind of clarify one thing, single filers also includes heads of household. It includes, filing by yourself. So any of the other statuses that involve filing by yourself can also use that single range. And last but certainly not least, let's talk about deadlines. If you're new to IRA investing, you might not know this, but you can make your contributions up until the tax deadline. So that means for 2024, you can make your contributions all the way up until the April 15th, 2025 tax deadline. So you really have a 15 and a half month window in which to make your contributions each year. So that also means that if you are just getting started, you can still make IRA contributions for the 2023 year and potentially increase your tax refund or lower your tax liability until April 15th of this year. Remember, the 2023 limit was $6,500. So if you open an IRA in early 2024, and if you're under 50, you could potentially put up to $13,500 in it, classifying some as a 2023 contribution and some as a 2024 contribution. So these limits will adjust every year based on they're indexed for inflation. Going forward, that catch-up limit will be indexed for inflation as well. And the income limitations are also dependent on inflation and change every year. So I will be back next year with a new IRA contribution video. But for now, please let me know any questions you have in the comments. Hopefully you found this informative, and Happy New Year, everybody. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.